Welcome back to the show. Today we are diving into some massive news shaking up the mortgage world. If you're looking to buy a home or you work in real estate, listen up.
Yeah, this is a big one. The Trump administration is officially dialing back the housing goals for the big giants, Fannie Mae and Freddie Mac, and it looks like low-income borrowers are going to feel the squeeze.
Exactly. We're talking about the goals set for 2026 through 2028. The headline here: they are lowering the bar on how many affordable loans these companies need to buy.
Let's look at the actual numbers because they tell the story. The Federal Housing Finance Agency, or FHFA, is dropping the low-income purchase goal from 25% down to 21%.
And for very low-income buyers, that goal is getting slashed from 6% to just 3.5%.
Advocacy groups are crunching the data, and they estimate this excludes about 177,000 working families over the next 3 years. That is a lot of missed opportunities for homeownership.
So you have to ask, why? What's the logic here? Well, FHFA Director Bill Pulte says the old goals were just too aggressive.
Right. The argument is that by forcing Fannie and Freddie to chase these low-income loans, it actually distorted the market and drove up prices.
Pulte's take is that they want to pivot focus to the middle class and stop competing in a bidding war for a limited supply of affordable loans. Basically, they want to reset the market dynamics.
But here is the rub. Critics, like the Center for Responsible Lending, are saying, hold on a second. They argue that the administration is misunderstanding who the middle class actually is.
Exactly. A middle-class income is usually defined as starting around 66% of the median income, but these cuts affect people earning up to 80%.
So by cutting support for low-income borrowers, they are essentially cutting support for the very middle-class families they claim they want to protect. It's a bit of a paradox.
There is another controversial change happening, too. They are getting rid of the specific sub-goal for lending in minority census tracts.
Yeah, instead of having a dedicated target for minority neighborhoods, they are merging it with the general low-income goal. The administration calls this a race-neutral policy to simplify things.
But groups like the National Urban League are furious. They say collapsing these metrics makes it impossible to track if Fannie and Freddie are actually serving communities of color or just ignoring them.
Now, not everyone hates this. The industry reaction is actually pretty split. The Mortgage Bankers Association, they're generally on board.
Right. They believe lowering the targets makes them more attainable. The idea is that if the goals are too high, lenders do risky things to meet them.
The Housing Policy Council agreed, saying that realistic goals prevent unintended consequences. So the lenders are breathing a bit of a sigh of relief here.
But then you have the heavy hitters, the National Association of Realtors. They are not convinced. They basically asked, where is the data?
Yeah, NARA's saying this move feels premature. They're worried that without rigorous analysis, this policy change is just flying blind.
Their fear is that if Fannie and Freddie step back, it doesn't fix the market. It just leaves a void that hurts homebuyers. They want a data-driven approach, not just a policy shift.
And that leads to the FHA problem. If Fannie and Freddie aren't buying these loans, where do those borrowers go?
Likely to the FHA or VA. And while those are great programs, industry groups are warning that we are shrinking the private market and putting all the risk on the government.
Private mortgage insurers are waving a red flag, saying we're repeating mistakes from 2012. We want private capital in the market, not just government-backed loans for everyone.
We also have to talk about the little guys, the credit unions. They rely heavily on selling their loans to Fannie and Freddie to keep cash flowing.
That's a great point. If Fannie and Freddie stop buying affordable loans from credit unions, those credit unions might stop making them altogether.
It's a liquidity issue. If the secondary market dries up for these specific loans, local community lenders might have to pull back, which hurts Main Street buyers directly.
So big changes ahead. And this is just one piece of the puzzle. The administration is also looking at rolling back disparate impact rules, which is a whole other conversation.
It really is a new era for housing policy. We'll be watching closely to see if this actually helps the middle class or just makes it harder to get a key.
We'll keep you posted. Thanks for tuning in, and we'll catch you on the next one.